Now, basically here, some of the things that I cover are the differences between these earlier halving cycles, the first and second specifically, and for example, the third halving cycle, which is what we're in now. The first and second halving cycles are very interesting because the market was very young. It was mainly whales or large holders and retail traders, and many of whom, traded with a strong lack of experience, which is understandable. And this was one of the largest reasons for the volatility. And something else to keep in mind is back then, leverage, derivatives, and bots were not nearly as relevant. They weren't nearly as available. It wasn't as large a part of the market as it is today, with the derivatives market, I believe, having significantly larger volume than the spot market today. And also, something else that's kind of changed the scenery between then and now is there was no institutional support at all. It was very little, if there was, but most of the traditional market were still scoffing at Bitcoin. They're still laughing at it and still not taking it seriously. And a lot of that was intentional because it threatened them in some ways. But basically, that adds a whole other effect to it because they trade differently than retail traders and crypto whales. And those are something you want to keep in mind when thinking of the differences between then and now, because that is very important for seeing really how the price action plays out. Also, right now, a lot of coins throughout the cryptocurrency ecosystem they have more use case scenarios. They're still speculative, many of them, and there's still many speculative projects out there. So always do your research. And none of this is financial advice. But there's more of a use case where you have things like smart contracts, decentralized apps, NFTs. So there's a lot more things being done with these blockchains that kind of give it a real world use case scenario that makes it more than just speculation. There's something actually behind a lot of these projects. So before we go into the next halving, there was one large scale dip, which some of you might remember, some of you might not. And basically, the large scale dip I'm talking about was the COVID crash in March of 2020. And this was something that was not just exclusive to cryptocurrency. It just wasn't. It was a lot of the other markets as well, but cryptocurrency, of course, as volatile as it is, took a 2-day 50% dive. And then even if you look, for example, extend that out from mid-February to mid-March, Bitcoin would go from over $10,000 to below $5,000, and even bottoming out at 3,800 on the 12th of March 2020. And there you could actually see this. So from here all the way above 10 here back in February, and then going down, and then you could see on March 12th that bottom near $3,800. I personally watched this happen, and I was trying to buy the dip on Coinbase at the time, and let me just say Coinbase has improved so much better when it comes to the dips and things, etc. Still not the best, but it's improved so much because then it was very, very hard. It was very, very hard, and a lot of orders were not processing on the regular Coinbase, and it was a little hard. But good thing is it eventually recovered after bottoming from there, and by the end of the month we were starting to see levels over 6,000 again. So that was pretty good. Of course, with this dip as well, there was a lot more institutional interest, etc., and a lot more eyes just watching it. A lot more people were curious, so there was a lot more attention on crypto, especially as COVID came and everybody went inside and people were looking for things to learn about. There was a lot more eyes on crypto then than there was, for example, in early 2018 / end of 2017 for the previous halving cycles.